Thanks, Senator Reed. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman, and I appreciate the plug for our bill together. We do things occasionally on a bipartisan basis, even in the Banking Committee, but we also have an opportunity once in a while to disagree, and sometimes that means that we get to have you folks participate in that disagreement process. Today, you're going to hear us talk a lot about consumers, as they are the latest victim of heavy-handed Washington bureaucrats. In the last few months alone, financial regulators have put forth or finalized regulations and guidance that represent the biggest rewrite of banking regulation since the passage of Dodd-Frank. We've seen regulations on bank capital, long-term debt, resolution planning, the Community Reinvestment Act, and climate risk management, just to name a few. However, we know that none of these regulations exist in a vacuum. Vice Chair Barr said himself that the Basel III endgame proposal is, and I quote, projected to raise capital for large banks. This may result in higher funding costs. But this is only half the story, end of quote. I want you to help tell the other half of the story. Now, I was just gonna ask this of one of you, but since our chairman has kind of set the example of asking folks to raise their hands, and I'm gonna apologize in advance because I think folks hate to be put in that position, I think it's critical that you get to tell the other half of that story. None of you raised your hands when you said that it would be, that it was a case of where you couldn't meet the capital requirements. The issue is what damage it does to the economy when you're expected to raise that and the folks who need that capital. So here's my questions, and I'm going to ask you to raise your hands. I apologize for that. But if you agree with these assessments, would you please raise your hands? Do you believe in its current form, could these regulations negatively impact first-time home buyers? Do you believe in its current form, could these regulations negatively impact those saving for retirement? Do you believe that these regulations could negatively impact our farmers and our ranchers? And do you believe that these regulations could negatively impact small business owners? See, this is the rest of the story. Sometimes we think that we're just beating up on the big banks, but the bottom line is it hits the American consumer where it hurts. This is at a time that when they try to go after the big guys, it's the American consumer that will suffer. You can already see the signs of consumers struggling as they are utilizing the buy now, pay later approach to products and making late payments on credit cards. This is because Americans are paying more per month just to get by since President Biden took office. Bidenomics has led to a family of four in South Dakota needing to pay over $900 more in month just to get by for normal living expenses. I'm going to say this again, regulation does not exist in a vacuum, and the Federal Reserve must take this into account as they work towards finalizing their rulemaking. I won't embarrass you by asking you to raise your hands anymore. I apologize for that, but I think it's important that the American people see the rest of the story and who is really going to pay the bill for this overzealous approach, and without finding out the rest of the story about these types of regulations and who really gets stuck with it. In recent years, U.S. federal debt levels have climbed further, and annual interest on the debt is slated to reach over $1.4 trillion in the next decade, almost outnumbering all discretionary spending. I'm concerned about what risk rising indebtedness poses to the economy. According to recent estimates by your institutions, the Treasury will conservatively need to issue $20 trillion of debt in the coming decade. I'm not only concerned about who is going to buy this massive issuance of treasuries, but with a federal funds rate of 5%, the federal government is going to be paying even more to borrow as treasuries with near zero rates mature. Mr. Solomon, how could sustained high levels of debt have adverse effects on the U.S. Treasuries market, the dollar, and the general economy?
Thank you for the question, Senator. This is a significant issue and one I tried to highlight in my opening remarks. The growth in the U.S. Treasury debt has been very, very significant over the last 15 years. It's more than tripled. That debt will continue to grow as the cost of refinancing that debt will also grow. The Office of Budget and Management, looking out through the decade, estimates a 3.5% cost to refinance the debt, but I certainly think there are scenarios where that cost could be higher. This cost obviously hampers our ability to invest in other things, as a nation that we need. There certainly is a lot of attention and focus on things that are needed to strengthen our economy, to strengthen our society, and the cost and that burden of the debt to future generations based on decisions we've made is something that we're going to have to get focused on. As the cost of debt goes up, it certainly can create volatility in our funding treasuries. It can create volatility in the treasury market. One of the things I'm also concerned about when I look at Basel III Endgame is one of the impacts is to a business called Prime. The business of Prime finances institutions' securities positions. So asset managers, investment managers, asset management platforms that regularly trade in the Treasury market provide liquidity to the Treasury market. And the cost of the financing that they have to finance those positions would go up with this proposal, and it could potentially, therefore, impact liquidity. And so that's another risk that I think we need to look at carefully.
Thank you,
But
Mr. Solomon.
Thank you.
Thank you,
Senator
Mr.
Tester.
Chairman.